about the first company on our radar. JB Chemicals is the first management on the show. It reported what was a healthy set of Q4 numbers. Margins improved year on year, while the CDMO business, which basically manufactures lozenges, crossed 100 crores for the first time in a fourth quarter of a fiscal. To discuss this and more, we have Nikhil Chopra, the CEO and whole-time director of JB Pharma, who's with us. Nikhil, hi, welcome to the show. Well, let's start with the domestic business. That was up around 22% in Q4. And the organic growth was, I think, around 13 odd percent if you adjusted for the Opthal business. Can you give us a sense in terms of how the domestic business did in terms of the acute and the chronic portfolio? And did it meet your expectations?
So, first of all, Ekta, good to be back on CNBC TV 18. And overall, it was a fair performance and overall outperforming in many aspects of revenue, EBITDA, and profits, which I will talk in detail. And the volume growth in chronic part of the business is as high single digit. That is what 13% organic growth. What you shared. And acute part of the business, as overall market has been flat, we were also flat for acute part of the business. So chronic has been the savior, where the volume growth was high single digit. And we continue to focus on our chronic portfolio within that: cardiology, heart failure, hypertension, lipids. That is what we continue to do. And some parts of our acute business, like probiotics and pediatrics, they also showed around 5 to 6% growth for the quarter. That is where we stood overall from India perspective. Also happy to share that all our 5 brands, that is Nicardia, Cilacar, Rantac, Metrogyl, Cilacar T, are now in top 150. That is where we stand as a company. And particularly in cardiology business, which is $3 billion market, we are now 8th ranked company. And we have crossed a threshold of 1,000 crores revenue. And we are the fastest growing company in cardiology in the country in top 10.
Right. Nikhil, always a pleasure speaking with you. I remember, once you'd come down to our studio speaking about your plans for domestic and growth, etc. itself. Let's take that forward. You spoke about a revenue target for the next year. If you could give us a sense of how much of that will come from domestic, what proportion of that will come from exports, what's the growth target here, and the lozenges business, the milestone, 100 crore in a quarterly revenue, that was one of your targets as well. What's the target for FY25 here?
So, Mangalam, today, 53% of revenue is coming from domestic. And 47% is our international business. And within that 47, 12% of revenue is coming from CDMO. So first, let me talk about domestic. 53% revenue comes from our domestic business, which probably a couple of years from here, you should see going as high as 60%. And major focus, as I earlier was talking to Ekta, would be chronic part of the business, where we want to intend to take our contribution of chronic business on the higher side. So you should see 60% coming from India. That is what we want. That is what we are aspiring for. And when we look at what we are trying to do outside India, today 12% contribution, close to $50 million, is coming from CDMO business, where 70-80% of business happens in terms of lozenges. And also what both you and Ekta were talking, that we could cross the threshold of 100 crores for the quarter. You should see this 100 crores, what we have achieved, probably growing at mid-teens in second half of the year, because a lot of projects that we have put in place, a lot of new therapeutic segments, new geographies, new partners, that will see the daylight probably in H2, that is October onwards, FY24, where this 100 crore should grow at around mid-teens. That is where we stand.
Okay, all right. Well, I wanted a brief comment from you with regards to margins, because you've always indicated that your guidance is 25 to 27%. You exited the year at around 26%. Q4 was 23%. Tell us, where are you going in FY25 when it comes to margins?
So, Ekta, I'm talking of operating margins, but let me first talk about the gross margins. Our gross margins for the year was 66%, and for the quarter was 65%. And this 65% gross margin for the quarter was because of 100 bips that we could see the dip because of the Opthal portfolio, where we could fetch around 35 crore revenue, where the margins are thin. So that happened for the current year, and 26-27% was our overall margins for the year. Going ahead, in spite of around close to 200 crore revenue, 190, 200 crore revenue for the year for our Opthel business, where margins will continue to be thin for next 2 years, we should be able to generate 65% gross margin and between 26 to 28% EBITDA margins. That is what we would like to do. This will happen with some more entire work that we want to do in the world of shifting our portfolio towards chronic, better product mix, efficiency drive, and equally our South Africa business, where we would have seen growth being negative. But happy to share that today our margins are much better as compared to where we were 3 years ago when we started the journey. And from here onwards, you will see margins just going up for our South Africa business also, because the private contribution, which was 40% to overall revenue, is now as high as 70%. So South Africa business margin improvement, overall chronic mix, CDMO business contributing mid-teens growth will only help us to derive our EBITDA margins close to 26 to 28%.
All right, so you've upped your margin guidance at least on the other end from 27 to 28%. That's interesting. Or your entire range, which is now expected to be 26 to 28%. Just a quick question before I hand it over to Mangalam. KKR, what is the plan in terms of the stake that they have? Have you heard? I'm sure you're in talks, I'm sure you're in conversations with them about what their future plans are. Are we expecting an exit this year from KKR, or are they already in active talks with PEs?
So, Ekta, not that we comment on market speculations. Our capex for last year was 130 crores. Our capex for this year will be 100 crores. 20% will be growth capex. The new partnership that we are putting in place for CDMO business. By the way, what I also wanted to share, that for the first time in history of JB Pharma, we have done BE filing of 10 products in our rest of the world emerging markets. This year also we'll be filing 10 more products. We have been filing 3 to 4 products. ANDA we are filing that we have been doing for US market. So all the work that we continue to do to drive the business and take the margins high, create value for the stakeholders, that is the dialogue that we have with our partners. Otherwise, I don't think we can comment on any market speculation or rumors.
But we still haven't gotten your answer, because there was news that they were looking at people like Torrent Pharma and a bunch of others as well. Just wanted to know if the deal is anywhere close to fruition in this year, or maybe they'll hold on for a bit because of the guidance that you've given in terms of growth prospects that they have.
Business continues to be as is, Mangalam. Last week only we had our meetings with our board members and with our KKR colleagues. And what I can talk is overall what we are trying to do in tomorrow in inching up the business, inching up the EBITDA margins, creating value for the stakeholders, serving more and more number of patients. On these all speculations, as a policy, we don't comment.
Okay, all right, tight-lipped as of now. Let's see what the future holds. But Nikhil, thanks very much for joining in and speaking with us and giving us your perspective with regards to JB Pharma. In fact, the company has increased its margin guidance. I think that really stands out. 26 to 28% is what they expect going forward. We'll take a short break, but